The stock for Ondas Holdings Inc., ticker ONDS, is currently trading at $7.51, up 63 cents, reflecting a jump of 9.17% in today's intraday market movement. This significant upward movement immediately challenges the recent narrative that had begun to settle around the stock, which was one of caution following a recent equity offering. Most people saw the capital raise, which was substantial, and immediately defaulted to the fear of dilution, suggesting the momentum from their strong Q3 earnings report would be fleeting. However, the unexpected twist here, the immediate insight, is that institutional buying activity is aggressively overshadowing that dilution concern, transforming the cash raise from a necessary evil into a war chest for expansion that the market is now applauding. It appears large players, including Hood River Capital Management and Renaissance Technologies, have substantially increased their positions, which is the definitive vote of confidence that retail investors might have missed while fixated on the share count increase. This influx of sophisticated capital, clearly visible in recent filings, is the real story today, and it forces us to reevaluate the stock's short-term potential. The general belief about Ondas has been a classic show-me story, a smaller, high-growth, high-burn technology company operating in critical sectors, specifically autonomous systems and private industrial networks. The expectation was that the Q3 earnings, despite showing a colossal 580% year-over-year revenue increase to $10.1 million, would still be overshadowed by the inevitable need for capital to fund that rapid growth. And this is exactly what the recent filing confirmed. The core thesis that Ondas is a speculative play on unmanned aerial systems for defense and secure rail communication was tempered by the reality of its cash needs and lack of sustained profitability. They are still operating at a loss, which is typical for a company aggressively scaling and integrating multiple strategic acquisitions. However, the deeper take, the reality that is now driving this stock higher, is that the market is beginning to value the quality of the revenue and the strategic execution over the quarterly noise. The massive revenue increase, coupled with the raising of the full-year 2025 revenue target to at least $36 million and setting a preliminary 2026 target of $110 million, paints a picture of a company hitting an inflection point in its growth trajectory. The backlog for its Ondas Autonomous Systems segment reached $22.2 million, which, when combined with acquisition-related contracts, totals over $40 million. This kind of revenue visibility, especially in the defense and security sectors where contracts are often long-term and sticky, is what institutional investors are prioritizing. They see the capital raise as enabling the acceleration of a proven growth model, not merely sustaining a struggling one. This is a crucial distinction that separates the surface-level fear of dilution from a deeper appreciation of strategic financing. Drilling down into the recent stock movement, the rebound from the slight dip post-financing is telling. The daily trading volume has been elevated, consistently exceeding its 30-day average, indicating high conviction behind the recent price moves. The stock experienced a significant surge following the Q3 report, and while it saw some profit-taking, it refused to drop back to previous support levels. This suggests a very strong floor of buyers stepping in on any weakness. The technical picture is supported by the fundamental news flow, the recent completion of the Centrix acquisition, which strengthens their counter-drone technology, and the expansion of their Rift partnership to include Nemo, a leading munitions manufacturer, which directly supports their strike drone offerings. These aren't just press releases. These are material events that expand their market access and product capabilities in the highly sensitive defense space. For those of you who manage your own holdings through an individual brokerage like Fidelity, or perhaps use a service like Schwab Intelligent Portfolios for diversification, the high volatility of a stock like ONDS presents a distinct challenge. You have to decide whether you are trading the daily swing based on the dilution headline, or if you are investing in the 18 to 24-month horizon based on the backlog and M&A integration. Speaking of brokerage choices, it's worth noting that an active trading platform like those offered by Interactive Brokers or even the mobile-focused Robinhood app is likely where most of the retail volume is transacting right now, trying to capture these intraday swings, while the institutional accumulation is happening quietly in the background. The business model of Ondas is bifurcated. On one side, you have Ondas Networks, which provides the full-max software-defined radio for secure, wide-area industrial networks, primarily serving the rail industry. This is the slower, more stable, but still critical part of the business, focusing on modernizing the communication backbone of major rail lines. On the other, and much more exciting side for the market, is Ondas Autonomous Systems, AAS, which is the high-growth driver focused on unmanned aerial and ground platforms for defense, security, and critical infrastructure. The AAS segment is where the bulk of the M&A activity is focused, adding AI-powered electro-optics, counter-drone capabilities, and ground robotics. This dual structure provides a slight counterbalance. The high-potential, high-risk drone business is partially offset by the secure, long-term contracts from the network side. Historically, the stock has been extremely volatile, swinging from a low of $0.57 to a high of $11.70 over the past 52 weeks, underscoring its high-risk, high-reward profile. Moving to the future outlook, the core tension remains. Can Ondas execute on its aggressive growth targets and transition from massive revenue growth to actual profitability? Management is targeting EBITDA positivity in the second half of 2026 and a 50% gross margin, which is a significant jump from current figures. The primary catalysts will be the successful integration of its recent acquisitions, Centrix, Apiro Motion, and others, and crucially, the conversion of its growing backlog to recognized revenue. For the AAS segment, securing more large multi-year government contracts in Europe and Asia following successful pilot programs will be the true validation point. The risk, of course, is that a complex integration of multiple high-tech firms is a monumental task, and a misstep could delay the profitability timeline. Furthermore, a heavy reliance on defense spending makes them susceptible to governmental budget cycles and geopolitical shifts. The stock's valuation, despite the recent pullback, still anticipates significant growth. The current analyst consensus is a strong buy, with a median price target around $11.00, suggesting a substantial upside from today's price, reinforcing the idea that the reality of the company's growth trajectory is currently exceeding the expectation that it's just another cash-burning startup. This institutional optimism, clearly seen in the recent ownership accumulation, is the key variable to watch. We are at a point where the execution over the next 2 quarters will either cement the strong buy rating or reignite the concern over operating expenses. I want to pause here for a moment and hear from you, the audience. Comment below with your thoughts on Ondas Holdings Inc. and specifically how many shares of a high volatility stock like ONDS you feel is an appropriate allocation in a personal investment portfolio that also holds core positions like Tesla stock or Nvidia stock. Your perspective on balancing risk in your online investment strategy helps everyone in the community. In summary, the narrative for Ondas Holdings Inc. has been flipped on its head by this current market action. The initial market expectation was that the recent capital raise was a distress signal, a necessary evil that would dilute shareholders and stall momentum. The emerging reality is that institutional investors viewed it as a strategic funding round, a move that provides the necessary resources to accelerate a proven high-growth business model in the critical autonomous systems and defense sectors. The stock is moving higher today not just because of the strong Q3 report, but because sophisticated capital is now validating the M&A-driven growth strategy and the company's robust backlog, a sentiment that had been largely absent in the preceding weeks of caution. This is a story of a speculative growth stock trying to shed its speculative label by showing hard, accelerating revenue and a management team that is aggressively capitalizing the business for its next phase of expansion. The long-term performance hinges entirely on their ability to manage integration and convert that backlog to bottom-line results. But for today, the bulls have definitely taken the field.